Sebastian Mallaby from the Council on Foreign Relations. Sebastian, you and I, good noon to you, Sebastian, first of all. From our Washington News Bureau, you and I spoke a few days ago about Germany. Just simply, has anything changed in the last 48 hours as far as Germany driving the bus in Europe?
Tom, they're still driving the bus, and they are driving it off a cliff. It's almost as though if they had a plan, a secret, devious plan to blow up Europe, this is sort of what they would be doing. First of all, on Monday, they say no Eurobonds. They reaffirm that position. Then now they're saying they're shooting down this idea of having the two different bailout funds for Europe, the EFSF and the ESM, running in parallel. That was an idea that was floated yesterday and then shot down this morning. Meanwhile, and I think this is the most stunning part of the whole story here, is that the European Central Bank chief, Mario Draghi, said last week, here's how the European Central Bank can be empowered to come in and put more money on the table to support distressed bond markets. We need a, quote, compact on fiscal union. The Germans completely ignore him, forget compact. They go for complete treaty change, which is going to take 5 years or more than 5 years. So they're just completely dissing him.
Okay, let's rip up the script here right now. This is really, really important. Language matters here, and Mr. Mallaby is better than good at this. There is a distinction between compact and treaty. What is that distinction? To us in America, Sebastian, the compact is something the Pilgrims did in 1620. What is the difference between a compact and a treaty?
Well, what the European Central Bank chief was trying to say is that you don't need to go for treaty change, which needs to be ratified in all the different countries of the European Union, or even just in the 17 Eurozone members, because that treaty ratification is going to be drawn out, difficult, and may even fail, right? So the European Central Bank was saying, please guys, give us the excuse to come and intervene in the markets to stabilize them and have a set of rules which could be less than a treaty change, more like a sort of Brussels-based directive that would say, here's how we're going to integrate our fiscal policies, and that would have empowered the European Central Bank. But, you know, the Germans just were not listening to that. They want full-on treaty change.
Very, very good. A dreaded first chart here. Let's just look where the euro is. This goes back to 1999. Europe at a crossroads. Our Peter Cook, I know, is in Paris this week. It's Tuesday was Belgium yesterday. A movie joke from years ago. You can see there, though, that trading range of euro. Do we have an issue here, Sebastian, that if the Germans mess this up as bad as you say they are, that they could get their worst outcome, which is a strong euro from a Europe torn asunder, and that would diminish their export capabilities?
Well, if the euro currency really broke up and you had a sort of revived Deutsche Mark, then clearly the Deutsche Mark would trade, you know, like any other currency from a strong, sort of well-managed economy. Look at Switzerland, for example. And in other words, the currency would go through the roof because nobody likes the dollar really at the moment. People would not like the other European currencies to emerge from the breakup. So there would be a huge flood of cash into Germany. The Deutsche Mark would appreciate, and German exports would be hammered.
Let's bring up the number right now, if we could, Elian, in control room here. The number, this is a great, thanks to Sarah for bringing this to our attention, Sarah Silverstein. Negative 58%. That's the estimated devaluation of the Greece drachma, this by Nordvig and the team at Nomura. And that goes against, look there, a 1.3% appreciation of the Deutsche Mark. I think that's a careful calculation by a financial house. Sebastian, I agree with you that the behavioral calculation here would lead to a much stronger euro appreciation under some form of reformed Deutsche Mark.
Yeah, that's right. I don't think that the Deutsche Mark would go initially to simply purchasing power parity, as some model would suggest. I think you'd get massive overshooting on the upside for the Deutsche Mark because currency is looking, money is looking for currencies that seem stable. And so, whether you look at Switzerland, whether you look at even Brazil, not now, but 6 months ago, you've seen huge flights of capital into economies that appear to offer a good deal. And I think that would be the case for Germany.
Here's a quick chart. Thanks to Michael McKee again for this chart. It's a 3-month euro basis swap. All you need to know is this is an indication of how easy it is to get dollars. Victor, focus in the lower right corner, and you can just barely see that line coming up. That is the improvement, the modest improvement of the last few days. Do you agree with me, Sebastian, that what we really need to see here is a cash call? We need to see money shown by Friday to actually get the confidence of the markets?
Well, that's right. I mean, basically, the most important number in Europe right now, if you're trying to measure the crisis, I think is the 10-year government yield in Italy. That was up at 7.3 right after Thanksgiving. It came down to 5.9 earlier this week. I'm not sure, you probably have the number for now. But you know, that number needs to get below 6% and stay there if Italy is going to be solvent. And if Italy is not solvent, then the size of Italian bond markets mean that the risk of default will kill banks across the continent, force deleveraging that then spreads into the US, spreads into Asia, and that's the big nightmare.
Sebastian Mallaby, thank you so much.